Okay, we're going to talk about financial instruments, and initially we're going to talk about instruments that the company may have issued. Later on we'll talk about instruments that the company may have obtained, either purchased or however. So there's two main types of financial instruments, both equity and liability, and the main difference is whether there's an obligation at all for payment. So with equity instruments, there's no obligation at all. And the simple example is standard ordinary shares. So a investor will give the company £100,000 in exchange for shares, and the company has no obligation at all to pay any of that money back at any point. It's an investment. The investor hopes money will come back, but there's no obligation to pay it back. If there is, it's paid back through the form of dividends, and dividends are wholly discretionary. Again, no obligation for payment, and that's the critical factor for equity instruments. Now that's different to liabilities, and the simple example here is straight debt. Now here there is an obligation for payment. If I buy debt, a debenture from a company for £100,000, I'm expecting there to be some kind of interest payment, which will be paid every month or every year or every 6 months, however it's agreed, and I can rely on that payment. So the payment here is paid through interest, however it's formed. There may be a premium on the debt, but it all comes down to interest, and it's all an obligation for the issuing company to pay. So those are the main difference. What I'll add in here, just for clarity, is there's a claim on the final net assets. So there's no obligation for payment, but there is a claim. So that's the main difference. So let's look at how these might be measured. First of all, we'll look at equity instruments. The initial measurement will be fair value minus costs of issue. And how might that look? So let's have an example. Company X. Let's give them a name. No, I won't. Company ABC issues 100,000 shares at $4, and the shares have a nominal value of $1. Okay, so let's just format that. So the company ABC company issues 100,000 $1 shares at $4. So what's the accounting for that? Well, obviously we can debit cash, as we have received money into the company. Put the debit there. Debit cash. And we have received, well, we've received 100,000 times $4, so that's 400,000. And we will credit. Credit goes to equity shares of $1, and we've sold 100,000 $1 shares. 100,000, and we're also going to credit share premium, and the difference between the share amount, or the price of the shares, and the equity share amount goes into the share premium account, and that's going to be the difference, which is 300,000. 300,000. Let's just move that up. So that's almost the entire transactions. Let's just move that into the credit column. So we're debiting cash 400, that's how much we've received. 100 goes to credit equity shares, and 300 goes to credit share premium. So that pretty much balances, 400 on each side of the equation. But we haven't taken into account transaction costs. So let's put a figure for transaction costs here. Costs equals, call it £10,000. Cost equals 10,000. So let's do a double entry for the costs. So we're going to have to credit cash to pay the costs. So we're going to remove 10,000 off cash. 10, let's put these commas in, make it slightly more readable. 10,000 for cash. And where does that cash come from? Well, it's credited, or rather debited, off the share premium account. There's very few uses for share premium. One of them is the payment of new issue costs. So we'll take 10,000 through a debit onto share premium. So that's the whole transaction for the issue of these new shares. We debit cash with the full amount, and we split it between equity at $1 a piece, and the remainder goes into the share premium account. And then we pay cash. 10,000 goes out of the cash account, and that's balanced off, paid for through the share premium account. And that is the accounting for the issue of equity. Let's have a look at the issue of liabilities.